Broadcasting from beautiful, tropical Vero Beach, Florida, it's Money Nation with Ed Gardner.
Good morning and welcome to Money Nation. Today's special guest, we've got Joe Cunningham from Global Capital in Minneapolis. Joe, how are you today?
Yeah, hi Ed, doing great. Thanks for having me. Let me rephrase that. I was doing great until Friday afternoon when Jerome Powell decided to rock our world. We were enjoying a pretty nice summer, days at the beach, sunny skies, a nice leisurely stroll into the autumn. And then, Powell had to come out on Friday and, kind of ruin it all for us just as we were, getting started. So much for the summer rally. It's over.
What do you think about that? It's been a rough couple of weeks. Market going up and down like that. People think we got a soft landing and then it turns right around.
Yeah, sentiment's going to be tough to read here. It's one of the reasons we use a service for market sentiment that scrapes, social media and search terms and discerns whether it's a bullish or a bearish comment through natural processing language, and we get a little bit of insight from that service. But I would say that we're the vicissitudes that were in the markets today are here with us for the medium term, to be sure. Look, the VIX is about probably where it should be in the mid 20s, and any higher we'd be concerned, and any lower we'd be bored, right? So we're right in the middle of it. The thing that gets me is I have every confidence that Powell is going to be able to do the job. The question is, which job? For one, it's the Fed's position that they need to crush demand to stem the tide of inflation. When I would argue that it's really, so that's the demand side of the curve, I would argue it's really a supply side of the curve issue, right? It's about getting the goods and getting and readjusting our supply chain, which is undergoing a generational fundamental change as we deglobalize, or whatever you want to call it, right? And focus instead on the supply side of the equation and don't crush demand. Once you do that, it's hard to bring it back. So, the balance has got to be there. And his speech was just unusually harsh. I don't know, Ed, if you remember, but, back for many years, I followed the Fed and I have deciphered the indecipherable Alan Greenspan and listened to the Humphrey Hawkins testimony over the years. And I'm pretty good at this stuff. And that speech was just way too harsh. It was 8 minutes. It wiped $1 trillion off the market.
Yeah, why do you think he was not like that? Why did that tone and those words?
So when I listen to it and I play it back and listen to it again, I'm like, there's the phrasing of the speech can be managed in a much more benevolent way to the markets. It doesn't. You don't have to come in with a sledgehammer when a tacking hammer will do. You could say the same message without being so harsh in your rhetoric, and the speech could be a little warmer. It's the annual Jackson Hole symposium. Everybody's out there having a good time, enjoying themselves. The academics are there. The Wall Street practitioners are there. The Fed governors are there. It's really about them, the Fed governors and the monetary. The ministers, the finance ministers from around the world. So just have a little warmer tone, have a little lighter touch, and try to mitigate, the impact on the markets. All he did was spook everyone, and now we're $1 trillion less well off than we were a few days ago. That's a lot of money.
No doubt about it. How do you think earnings are going to be this week? I mean, we had some mixed bag last week. Palo Alto was good. Some companies are doing good. Other companies not so good. What do you think about the range of the market, S&P? I mean, I heard Tom Kim last week. He's a smart guy, really articulate guy. I think he's in 4,800 on S&P still. He said it's hard to believe that when you're in down days like last week when it was getting slaughtered. But what do you think about earnings coming up, and where are we going to be by the end of the year?
Well, I think companies are going to have to adjust to the new normal, right? And that includes their expectation on earnings and what they communicate to the market on earnings. So I think that's going to start to narrow the scope that they can of what they can communicate. So I think earnings right now are going to be fine, but we're not really worried about right now. We're worried about 6 months from now, right? 3 months from now, a year from now. What are they going to look like? And they're going to be adjusting to this new environment, this new normal. So where I might differ from some is the market has typically bounced from these types of vicissitudes. If it takes a sharp sell-off, we usually see a bounce up the next day or two, and we haven't seen that this time. So that might suggest, that we're entering into a new normal range of where the stock market is going to trade. So 4,400 on the S&P might be a little bit optimistic. We were trending in the right direction, certainly before Friday or before last week, really, because the market started to adjust as we got into the week. But that has those expectations have changed. And as you know, when stocks add, it's all about expectations. And right now, I think we may be in this new normal range where we're going to trend from this lower base. I like the markets are not doing well again today. We're heading into a longer weekend. People probably don't want to take the risk. The big players are out in the Hamptons or wherever they go these days. And we'll see how things shape up in September. But as you know, Ed, September can be a very volatile month as people come back and reassess and rethink and reallocate and rebalance and do all the things that they do. We've lived through them.
Yeah, we are below 4,000 now, or 39.86. What do you think? Yeah. I know it's roughly 4,000, but I think someone yesterday mentioned it broke some kind of a support level. What do you think about it? Where can it go? How much lower can it go?
So you look at the moving averages and, the 50 and the 200, and, so we're at a support level, and, I don't think we're going to break the 200 anytime soon. If we were to, I forget where it was, but that would be a very bullish signal. So I see, if I had to make a call by the end of the year, 42.50 kind of thing would be, reasonable. I don't see a breakout here anytime soon. There's still a lot of money in the market, to be sure. In the general economy, the Fed is missing its goal on repurchases, and so that is an issue. There's still 11 million job openings in the country. 11 million, which is just a staggering number. Job openings. So right. There's still demand out there, and the economy is going to do. I think pretty well. The economy is going to do well. It's whether or not the Fed supports or, again, they seem to be into that where demand destruction meets supply constraints, right? So you're going to have to find a balance in there between the two. And I think that the Fed will likely manage this reasonably well, and we may or may not hit a recession. As you know, Ed, the yield curve's inverted. It's been inverted for a period of time now. The longer that goes on, the stronger the likelihood of a contraction, a more severe contraction. I think 8 out of 10 times that the yield curve is inverted on the 2 to 10 years, we've had a recession. So 8 out of 10 is a pretty good indicator that, something's going to happen. The question will be, how severe. And but again, our view is you're managing the wrong side of the demand supply curve. Let's hit as a supply sider. My think tank days, I was on the supply side shops. Let's give some incentives to the producers and give some love to the importers, and strong dollar is going to be an issue, but let's try to work out the supply side of the equation before we crush demand. Pretty simple.
Yeah, the 2-year is much higher than the 10-year right now, or 20 basis points higher. It's really odd to see that. And so 8 out of 10. Now, the question is, a recession, most people, a lot of people think we're in the recession already. The question is, how severe? Is that's what they will go back to? Is it going to be an easy one, or is it going to be a light one, or is it going to be more difficult? And that's
No, you're absolutely right. And so part of that will be predicated on the strength of the dollar. So if I may, I'd like to just look at the dollar, because in our universe, the dollar is kind of at the center of the wheel. If we use a kind of a hub and spoke methodology here, and the dollar's at the center. So the dollar index now is at 109. It's just couldn't be any higher. I don't think it's just crazy high levels. The euro to the dollar is now broken parity. So the dollar and the euro. I'm thinking of retirement in Europe now, Ed. I'm just saying.
Yeah, I think that'd be nice.
But the yen's at like 138. So for me, the yen has always been overvalued, and the right price is probably closer to 200 than 100, anyways. So. But what's driving the yen weakness is government debt is like 250% of GDP, where the U.S. government debt is like 130%. So there are fiscal imbalances there that are going to support the dollar over the yen, and the Japanese still have their ongoing demographic crisis, which will never be solved because they'll never allow immigration. So that's going to be a weakness. But on the euro side, is the dollar strong or is the euro just weak? And I would argue that the euro is just weak for a lot of reasons. One, twofold really. They bet on cheap imports and trade with China, and they bet on Russian energy, and both appear to be losing propositions right now. Right, China is still in this weird lockdown thing that they're doing. They're coming out of it, but their economy is reorienting itself, and we all know what's happening in Russia. So they're going to have a period of adjustment, and that adjustment may be opportunities. So when the dollar's strong, it's more expensive to export, right, for the U.S. companies, but it's cheaper to go out and buy your competitors overseas, right? So it's a double-edged sword. Why not just, U.S. companies should just be out there looking at European properties, looking at European assets, or globally, and making a play for them right now. Right now would be a perfect time for that. And, with the deglobalization or the anti-globalization push, we haven't really seen that in terms of flows. So I think it's more rhetoric than it is actual implementation by companies in terms of where they're putting their money. So this would be something to watch going forward, is how these companies respond to the strong dollar and what they do with their excess reserves, and they're sitting on a ton of cash.
We talked about the tips earlier in the year and how they're an indicator. What's going on with those? What are you seeing with the tips?
Steady as she goes, Ed.
Yeah.
270, 2.78, I think, thereabouts. So pretty steady, pretty rock solid. What I haven't seen, so there's a relationship between the tips and gold. And the tips, they have trended up, but gold has not moved. So I think gold might be a little overvalued at this juncture. And, it's been sticking, 1,800, 1,700 kind of, ticks up a little bit more. There were some pretty wild predictions for gold a year or so ago, and they never really came to fruition. But, there might, so gold is the par excellent hedge for inflation, right? So we want to see something move in that market, and it's just not happening.
Hey, Joe, we're going to take a quick break here. We'll be right back. Thank you everyone for listening to Money Nation, and we'll be right back after these messages.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and our guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back to Money Nation. Joe, let's talk about some geopolitical. What's going on with the modern-day Rasputin? We talked about that a little while ago. Let's give us your take on what's happening.
Yeah, it's a great international whodunit, right? This is Dugin, the Rasputin for Putin, as we like to call him. But the fact is that the two never really have met, and whilst they seem to share that they seem to be reading from the same or singing from the same hymn book in terms of Russian nationalism and the great Russian century and return to Mother Russia. You know, Russia was always a second-rate power, even during the Tsarist days. They never had the gravitas that the 10 time zones that they own would have suggested. And as you know, they defaulted on my debt years ago, so I'm not convinced.
I know that very well.
Yeah. However, there's something intriguing about what happened when Dugin's daughter was assassinated. And it's kind of a funny one because you can't really put the whodunit. You can't point a finger at, if the Kremlin wanted her dead, as we know, they have ways of disposing of people. If the U.S. spy agencies wanted him or her gone, they have ways to do it. It's professional. This was an unprofessional hit. So that would suggest maybe it's a terrorist group, or maybe it was the Ukrainians or some other thing. And the Ukrainians were quick to distance themselves from that because they knew that would be, unholy hell for them. And the terrorist group were not obvious. So the intrigue here are the oligarchs starting to rear their ugly head and come into take back their positions of power, right? So if you lost a $500 million yacht and your assets were frozen in France and your house in France and England and New York were inaccessible, you might have some cause for to ruffle some feathers back in Mother Russia. So that's where the narrative seems to be leading in my circles, that this was more an oligarch or a group of oligarchs who are come to, for Putin, they're coming home to roost. So we'll see. Now, Dugin he was advocating.
Or they were after the guy?
Sorry?
Were they after the girl, the daughter, or were they after actually the Rasputin?
She was kind of his mouthpiece. She was the TV star. She was the one you saw. He was the philosopher, right? Or he is a philosopher. He's a political economist, about what we would term. And he had actually been calling for, or he was suggesting that the Russian cabinet would turn over. It would be a whole new cabinet by the end of the year, and that Putin was off course, and this thing was not played out the way it was supposed to, right? So there's some discord in Moscow, and it's worth paying attention to. Look at the fact of the matter is the ruble is one of the best performing currencies in the world this year. It's up like 32% from the beginning of the year.
That's amazing. Who would have thought that?
Right. Who would have thought? And Russia, as an economy, is adjusting reasonably well. Newfound trade friends in China, of course, and India and North Korea. Who would have thunk? So their economy seems to be doing okay. They are now. There's another big brain drain happening in Russia, and they're encouraging Jews to resettle into Israel, and we've seen this time and time again, so we'll see what happens. But the fact of the matter is Russia has so it begs the question: are the sanctions working? Right, and they are to a degree. For sure, that's isolated the country. The biggest thing is out of the SWIFT system, right? Which was, how you move money around the world. And it's out of the BIS, Bank of International Settlements, and all that stuff. So the rather sophisticated banking sector in Russia has been neutralized. The global energy markets are shifting. So, now China's found a new source for its oil needs, although they're shifting from going green to coal, back to coal. It will be interesting to watch. But yeah, I don't think your listeners will realize that the ruble is one of the best performing major currencies in the world.
That's amazing. It appears that the sanctions really, how much are they really hurting Russia if their currency is at a year high versus everyone else?
Yeah. So one of the they are de-dollarizing, if that's even a phrase. So Putin is expecting people to pay for their energy in rubles. So that's going to drive the demand for rubles. Bulgaria and Poland have refused, and they've been cut off of the Russian energy supplies. So look, things are going to get sticky come October, November in Europe, and it's getting cold, and oil is not a bad place to be.
They may even put more pain towards Europe. When it gets cold, and they can really hurt them.
Definitely. So B of A, Bank of America, has a per barrel price target of about 140 on oil. So that's pretty high, and I don't really agree with that. I think it's probably about the right price now, give or take. And we'll have to see.
Better lock in your home heating oil in Minneapolis, Joe.
Ed, it costs so much money to heat this house. Double pane windows and all.
Joe, thanks for being with us here on Money Nation. Have a great week. And all listeners, thanks a lot for listening to Money Nation, Vero's Voice. Everyone have a great day and a great week.
Thanks, Ed.
Thanks.